Here's a funny thing about modern economies. They don't actually want you to get rich. I mean, sure, they'll tell you all day long about building wealth and achieving financial independence and crushing your goals. But the machinery underneath? It needs you broke. Or, more accurately, it needs you spending. Because modern economies are built on a fundamental principle that nobody likes to talk about out loud: perpetual growth. And perpetual growth requires perpetual consumption, which means you need to keep buying stuff, keep taking on debt, and keep spending money you don't have. The moment you stop consuming, the system starts to break. And here's the beautiful part: the system has engineered itself so that whether you're rich or broke, you're spending anyway. Let's start with how this actually works. Most people think of the economy as this meritocratic thing where you work hard, get promoted, make more money, and eventually achieve financial security. Simple, linear. But that's not what's happening at all. The modern consumer economy is designed around a concept called negative savings. And it's not an accident. It's not some unintended consequence of capitalism gone wrong. It's the actual plan. Because when you look at consumer spending data in developed economies, it's around 70% of GDP. 70%. That means if consumers stop spending, the entire system seizes up like a 2-year-old's toy factory. Unemployment spikes, businesses fail, tax revenue collapses, and governments start panic selling bonds to keep the lights on. So you'd think the system would be designed to encourage savings, right? Build up your emergency fund, invest in your future, get out of the spending treadmill. But that's basically the opposite of what's happening. Credit card companies spend billions figuring out how to get you to spend more. Banks make more money from your interest payments than they do from actual interest on savings accounts. The average savings account pays you 0.5%. Meanwhile, the credit card in your wallet is charging you 22% interest. That's not a coincidence. That's intentional architecture. And it goes way deeper than just credit cards. The entire consumer credit system is engineered to normalize debt. When did it become normal to finance a car? Not because you can't save up the money, but because the system decided that we should all be paying interest on stuff we're going to own anyway. Back in the 1950s, you saved up and bought a car with cash. Today, you roll into a dealership and finance a $35,000 vehicle over 6 years. You're going to pay an extra $6,000 just in interest for a depreciating asset, but the system needs you to do it. Because if everybody paid cash for their cars, the auto financing industry would collapse. And that's billions of dollars in interest income that just evaporates. The same goes for furniture, for appliances, for basically anything that used to be a one-time purchase and is now a financing opportunity. BNPL services like Affirm and Klarna aren't disrupting the market. They're just repackaging the same old debt machinery in a new wrapper. Then there's student debt. Generation after generation has been sold the idea that you need to take on massive amounts of debt to get a degree that might not even pay off. And I'm not saying education isn't valuable. I'm saying the system has convinced you that going 100 grand into debt is the normal pathway to adulthood. It's not. It's the pathway to spending most of your 20s and 30s paying off interest instead of building actual wealth. Student debt isn't an investment in your future anymore. It's an anchor. It's a way to extract decades of labor from young people who have no choice but to accept whatever job is offered to them. But the system needs you in debt, because a person who's 100 grand in the hole isn't going to do anything radical like quit their job, start a business, or opt out of the consumption cycle. They're going to work, they're going to earn, and they're going to spend to stay sane. They're going to buy things they don't need because at least they have that one small dopamine hit to look forward to. Then there's housing. Housing was supposed to be an investment, a way to build equity. Instead, it's become a speculative asset. And a lot of people are now stretched thin on a 30-year mortgage because housing prices have been artificially inflated by institutions buying up single-family homes. treating them like stocks. So you're not just spending on a house. You're spending on a house that costs 3 times what it cost 30 years ago, adjusted for inflation. And the system needs housing prices to keep going up. Because if they don't, if real estate becomes affordable again, then the entire mechanism slows down. Here's the thing about the consumption treadmill. It doesn't even require you to be rich. In fact, it works better when you're not. When you have money in the bank, you have options. You can say no. You can walk away from a bad job. You can take risks. You can spend less. But when you're living paycheck to paycheck, when you've got credit card debt and a mortgage and student loans hanging over your head, you don't have options. You have obligations. And the system needs your obligations more than it needs your actual wealth. This is why wages have essentially stagnated for the last 40 years when adjusted for inflation. If wages had kept pace with productivity, the average worker would be making significantly more money. But they're not. Because if they were, they'd have actual savings, they'd have stability, they'd have leverage, they'd be able to say no to bad employers, they'd be able to walk away from exploitative situations. The system can't have that. The system needs you working, spending, and barely keeping your head above water financially, desperate and dependent. Because the moment you accumulate actual wealth, the moment you build a real safety net, you stop participating in the consumption engine. You stop taking on debt. You stop chasing salary increases because you're already comfortable. And when you look at credit availability, it's designed specifically for this. During the 2008 financial crisis, millions of people lost their homes. But did the banks tighten lending standards? For like 2 seconds, sure. But then they went right back to giving out credit to people who couldn't afford it. Because the system depends on it. Credit isn't extended because banks think you'll pay them back. It's extended because banks know they'll make money either way. If you pay it back with interest, great. If you don't, they get your assets. Win-win for them, zero win for you. The cruelest part about this is that the system sells it back to you as freedom. Buy now, pay later. 0% financing. Rewards credit cards that help you accumulate more stuff. It's all framed as though you're winning, as though you're getting access to things you couldn't otherwise afford. But what you're really doing is paying for everything twice, once at the store, and once through interest and fees. So here we are in this bizarre economy where you're simultaneously encouraged to be financially responsible while being systemically prevented from actually being financially responsible. You're told to save while the interest you earn gets decimated by inflation. You're told to invest while credit card companies are literally advertising 22% interest rates to desperate people. You're told to get ahead while the system is engineered to keep you exactly where you are, spending, in debt, and dependent on the next paycheck. And the economy doesn't want this to change. Because the moment people stop consuming, the moment people start actually saving and building wealth outside the credit system, the whole thing unravels. So the incentives are all misaligned. The system rewards consumption. It punishes savings. It normalizes debt. And it makes sure that whether you're broke or whether you're making 6 figures, you're probably spending more than you should be. Because that's not a personal failing. That's the entire point.